Dexcom stock is down 7% in after hours trading today after the company posted its latest earnings results. Let's take a look at why it's struggling and if it's worth buying right now on weakness. If you like this content and want to see more of it, check out smartstocks.ca and also be sure to subscribe for more of these types of videos. So on a year-to-date basis, Dexcom stock is down around 40%. So this latest weakness really isn't too much of a surprise. It's a bit of a continuation of the story of the company struggling to generate much growth. And unfortunately, this past quarter was no exception to that. So Dexcom makes medical devices, specifically continuous glucose monitoring devices or CGMs. So they're used by diabetics, and it recently introduced a new type of CGM that doesn't require that can be used for people who don't require insulin and who just want to track their glucose levels. So it's a new opportunity for the company, new potential growth avenue for the business. But lately, the numbers haven't been that great. So if we go into the numbers, we can see that this was the revenue for the period ending September 30th, 994 million versus 975 million. So the overall increase was just 2% year over year. Net income 134.6 versus 120.7. So a bit of growth on the bottom line. But the big problem, obviously, is that revenue only grew by 2%. And in the US, it was actually down 2%. It was the international revenue growth of 12% that helped pick up a bit of that slack. But obviously, when there's not a whole lot of growth and even a decline in the US market, that's a bit of a concern for investors. And here we see reference to Stelo, the company's new sensor for people with prediabetes and who are not on insulin therapy. So again, a good opportunity for Dexcom, first over-the-counter glucose biosensor in the US. So it's a big opportunity for them. And they've been advancing their product and launching it in new markets, Australia, France. And so there's a lot of opportunities for Dexcom, especially as the number of people with diabetes increases over the years. So it's a potential good growth opportunity. But one of the reasons investors have been worried about the stock is that with a lot of people taking Ozempic, a lot of GLP-1 weight loss drugs and losing weight, there's fewer people who may need to take or to track their blood sugar levels, could result in a decline in the number of people with diabetes. And so there may be less of a need for CGMs. And so that's one of the reasons why investors have been a bit concerned, especially with Dexcom reporting such weak numbers recently. So if we look at their bottom line, back to their bottom line, their diluted net income per share is just 34 cents. So that's fairly light, because if you extrapolate that out over an entire year, so if we take 34 cents times 4, that gives us 1.36. But the stock is trading at around $70. So if we take 70 divided by 1.36, that means their EPS is going to be around 51 times. Right now it's about 46, but if that earnings continues to be at around that 34 cents, let's say, then we're paying 51 times earnings for a stock that's not even for a company that's not even growing in the US. So it's a bit of a concern for investors, because obviously even 20 times earnings might be a stretch for a company that's not really generating any growth, especially in the US, right? Obviously they are growing internationally, but the core business being in the US is going to be a big concern for investors. So over the years, Dexcom has done fairly well, still up over 100% in a 5-year period, but paying that much for the company is a bit concerning. If we look historically, the PE ratio has been much higher than that. It's 5-year average 138. So people have been paying a high multiple for the business in the hopes that in the long run it's going to pay off, because the number of people taking diabetes or who have diabetes and who need the company's CGMs to help track that, that might increase in the future. But now with GLP-1 drugs and Ozempic and all those types that are helping people lose weight, the concern is that maybe the demand isn't going to be that strong. And last quarter, the company's sales numbers weren't great as well, and it blamed a change in the sales force and things like that. So really, it was an odd excuse for the company to say that why it was struggling. That being said, Abbott Labs also makes CGMs and it's been doing fairly well. It's still been generating good growth. So there may be some credibility to the issues plaguing Dexcom that it claims to be related to its sales force. So it may be a bit early, I think, for investors to push the panic button on Dexcom, even though it's been struggling of late. Overall, regardless of how effective these weight loss pills are with Ozempic, Mounjaro, all those other ones that have come out, I still think there's a lot of potential for Dexcom to get things right and get back to generating growth. It's still going into new markets. It's just launched Stelo, that new CGM for people who don't require insulin injections. So I think in the long run, there's still a good opportunity for Dexcom to grow. I don't think that all of a sudden the business is doomed just because it had a couple of soft quarters. So I think it could be a good buying opportunity, especially now you're getting it at a far lower multiple than it's been averaging in the past. Obviously, there is some risk that if it's not generating much growth, it could continue to decline. But I think overall there's still going to be a lot of need for these CGMs and for Dexcom's products. So I wouldn't be overly bearish on the stock right now. If anything, I think it might be a good opportunity to buy in right now, just because as it scales, its business continues to get bigger. There's still going to be a lot of growth on the horizon. So it has had a couple of bad quarters, but I think in the long run, this could still have the potential to be a great buy for investors.